Robert, what was your take on this inflation report? And is it the smoking gun, perhaps, that suggests that the Fed is done and dusted when it comes to rate hikes stateside?
Well, the Fed's got a lot of information to come over the next 2 to 3 months before they have to make a decision before the end of the year. They are likely going to be on hold next week, just given the fact that these inflation numbers have been coming in favorably for them. The core inflation number now has been 0.3 or less over the past 3 months. So the Fed will have a good look at, the next 2 to 3 employment reports. And if they are going to hike, as you note, it's about a 50-50 chance by the end of the year. And we'll get some very big clues over the next 2 to 3 months.
Here's the big risk that I think markets aren't paying enough attention to, and it's in the energy and commodity space. Oil now tracking at a 10-month high. We've seen prices testing 90 USD this month. Do you think that complicates the disinflation story?
100% it does. And I would have said the biggest risk to the inflation outlook is the oil story. As we think about the connection between oil and inflation expectations, that may cause the Fed to move if crude stays up here. Gas prices were up about 6% in the U.S. In August. And if inflation expectations move, that could get the Fed to move. We saw Jay Powell indicate that last June. When inflation expectations tick back up, that's when they move from that 50 to 75. And we really need to see how that happens. The flip side of that energy move, though, is that may crimp consumption in the U.S. And so how will the Fed contend with potential slower growth or slower consumption growth as those funds go to pay for higher energy prices? So there is some push and pull, but the main channel in which the Fed could act would be managing those inflation expectations if they do rise due to the energy prices, and that is the biggest risk to the call right now.
Indeed, and high energy could be demand destructive, as you say, so let's see how that situation unfolds. Of course, this isn't just a complicating factor for the Fed, it's also an issue for the ECB, which are also meeting today. So walk me through it, Robert. Are we going to see another hike today from the ECB, or is it time for Madame Lagarde to cool jets here?
Well, you noted earlier, the biggest thing for the ECB today will be the tone. And if they want to keep that sort of stick out there, a hawkish hold is probably the better thing for the ECB to do. Because if they hike today, it's very difficult for them to convince the market that they might hike another time. And so cuts are already priced in. They're very small, but as soon as January of next year into the curve. And so if they want to keep the threat of a hike out there and keep, the fact that they may not be done, a hawkish hold is the better route for the ECB. However, we have seen, the classic sources stories come out in the press suggesting that a hike is imminent. Odds went from just 6 basis points of hikes a couple weeks ago to about 17 this morning. So, we think the discretion is the better part of valor on behalf of the ECB today. Again, let's see how growth comes in. Germany is taking down their growth forecast. And so, we need to sort of see how the European economy evolves over the next couple months before they actually might hike again. But again, it's time for them to maybe take a pause here or skip, as was noted in the Fed, and look towards some more data before they do it potentially like they did in 2011.